Hey, this is Yossi. I run a small investment firm that specializes in REIT investing, and in today's video I want to highlight two specific REITs that I plan to buy ahead of September 17th, which is when I expect the Fed to cut interest rates. Right now the debt market is pricing in a 65% chance of a rate cut in September, but if not, then it's pricing a 90% chance of at least one rate cut in October. I'm bringing this up because this is just a few months away, and I think that this will be very bullish for the REIT sector. Remember here that REITs are today still priced at near decade low valuations, and this is almost entirely due to the rate hikes of recent years. But if rates crash due to rate hikes, then it also means that they should recover as rates are now cut down to lower levels. And you don't have to take it from me, you can just look at how rates reacted to when the Fed started cutting interest rates in late 2023. They've already recovered by 35% on average since then. At one point, they were up closer to 50%, but they've given up some of those gains as the Fed took a wait-and-see approach when Trump came into office. Now it appears that this wait-and-see approach is slowly coming to an end, and interest rate cuts will restart soon, and I think that that's when REITs will continue their recovery. Right now, the debt market is pricing in 4 rate cuts within a year from now. That's very significant, that's about 100 basis points. Morgan Stanley is even more aggressive. They expect 7 rate cuts by the end of 2026. And the reason why they expect interest rates to drop so much is because we've now brought inflation back under control. Its real-time inflation has been below 2% for about 2 years. Tariffs could lead to a bump in inflation, but it's expected to be modest and only temporary. Most of the rest of the developed world has already cut down their interest rates to much lower levels, often in the 2s. And now the economy is weakening also as a result of the trade war and the uncertainty that it creates. And so the Fed will need to step up to start supporting the economy by cutting interest rates. I think that this is very bullish for certain specific REITs that have recession-resistant business models, but have a lot to gain in terms of their valuation multiples as interest rates return to lower levels. The first company that I'm going to discuss is a safer bet. The second one is a more aggressive one for investors with a higher risk tolerance. Okay, now we get into it. The first one, which is the safer bet, is NNN REIT, ticker symbol NNN. This is today our top pick in the net lease sector at High Yield Landlord. In case you're not familiar with net lease REITs, these are companies that typically own properties such as pharmacies, dollar stores, convenience stores, gas stations, quick service restaurants. These are properties you see in your day-to-day life. These are single tenant, freestanding, service-oriented retail properties in most cases. And we call them net lease properties because the lease is structured in a way to be highly favorable to the landlord. Typically, the lease term is very long, at 15 to 20 years. Then they include automatic annual rent escalations of 1 to 2% per year. And importantly, the landlord has no responsibilities, which means that the tenant is responsible for all property expenses, including even the insurance, property taxes, maintenance, and so on. And so as a result of all of this, net lease properties typically generate highly consistent and predictable cash flow that's similar to how you would earn cash flow from a typical bond. The duration is very long, the cash flow is fixed with limited growth but highly consistent, and because of all of this, net lease rates are highly sensitive to interest rates. When rates are hiked, these rates tend to drop, but then when rates are cut, they tend to recover very strongly and even outperform the rest of the REIT sector. And this has been the case of NNN REIT as well. It has dropped by about 25% in the last 5 years, even as it steadily grew its cash flow in nearly every year. And so it's now a lot cheaper than it used to be not that long ago. At its peak, it was trading at over 20 times FFO. I think it was even closer to 25 times FFO. And yet you can today buy it at just half of that, at 12 times FFO. It's offering a 5.5% dividend yield that's very well covered. It's retaining about 35% of its cash flow. And NNN REIT is our top pick in the net lease sector today because it's only slightly more expensive than the lower quality net lease REITs like Getty Realty, which is overexposed to gas stations that face long-term headwinds, or EPR Properties that's heavily exposed to movie theaters, which also face long-term headwinds. Those are priced at about 11.5 times FFO. With NNN REIT, you're only paying a tiny premium, you're paying 12 times FFO. But it's a lot cheaper than the other high quality REITs like Essential Properties Realty Trust, Agri Realty, even Realty Income, which we think is a lower quality REIT than NNN REIT, but still priced at a premium relative to NNN today. And so I think it offers the best risk to reward. It's a high quality REIT that deserves to trade at one of the highest valuations in the net lease peer group, I think in line with those Agri Realty and Essential Properties Realty Trust, and yet it's trading at a discount. And there are 3 reasons why I think it deserves this premium valuation. The first reason is that it has an exceptional track record. The company has managed to grow its dividend for 35 years in a row. It has steadily outperformed the broader market, including even the S&P 500. Such an exceptional track record typically warrants a premium. The second reason is that it has a fortress balance sheet. It has a BBB+ investment grade rating, a low leverage of about 35% LTV, but importantly, its debt maturities are some of the longest in the entire REIT sector. It's the longest in the net lease peer group for sure at 12 years. As a result, it's not heavily impacted by the surge in interest rates. It only has minimal debt expiring each year, and so it's better positioned than most of its peers. This warrants a premium. Third reason is that its portfolio is less exposed to long-term headwinds. It has low exposure to movie theaters, pharmacies, dollar stores. Some of its peers like Realty Income are quite heavily invested in pharmacies and dollar stores, which in my opinion are lower quality net lease properties. It's more heavily invested in things like automotive centers, quick service restaurant, convenience stores. Those I expect to do really well over the long run. They expect them to do also well in a recession. Again, as I mentioned earlier, the company has a 30+ year track record of investing successfully in these type of service-oriented retail properties. And so this again warrants a premium. But despite that, you can today buy it at one of the lowest multiples in the net lease peer group at about 12.5 times FFO. I think that fair value is at closer to 16-17 times FFO, so there's about 30% upside. And while you wait, you're earning on 5.5% dividend yield. The company is expected to grow at about 4% per year over the long run. Just between the yield and the growth, you should get to near double-digit total returns. Add to that some upside, and you could get very attractive returns coming from what is a blue chip, lower risk REIT. And so I really like the risk reward, especially knowing that we're likely approaching the next rate cut, which could push the REIT to higher levels. Hey, before I go into the second REIT, can you please do me a huge favor and click the like button if you think that this content is helpful. Also subscribe to the channel to not miss my future videos. Thanks so much in advance. Okay, the second company I plan to accumulate more in the coming weeks is Star Holdings, ticker symbol STHO. And this one is a lot riskier, but its upside potential is also a lot greater. I think that it could literally double or triple if my predictions of rate cuts happen over the next year. And that's because it's essentially a leveraged bet on lower interest rates. The biggest asset of Star Holding is a significant equity stake in another REIT called Safehold, ticker symbol SAFE. In case you're not familiar with ground leases, these are a type of land lease in which an investor will lease the land beneath an existing building or with the intention of developing a new property. Such arrangements can be win-win because the tenant gets to control a piece of land for a very long time but not have to acquire it, and so it can lead to higher returns on his invested capital by simply owning the building, the structure, but not the land itself. It's more capital efficient for them. And on the flip side, the benefit for the landowner is that he's getting highly consistent, predictable, very secure income, because if the tenant defaults, typically the structures revert back to the landowner at no cost. But the reason why these are extremely sensitive to interest rates is that the lease typically are super long. It's about 99 years in most cases initially. So extremely long duration, and the cash flow is only increasing with fixed escalations that are limited. There might be a CPI component, but typically capped. And so you have a fixed income that's only slowly rising, and the duration is very long. And then on top of that, Safehold, the REIT, owns these assets, but it's leveraged as well on the corporate level. So it's extremely sensitive to interest rates. As a result of this, its valuation has crashed as interest rates surge. I think it has dropped some 80% from its peak, but this also means that it could now present huge upside as interest rates are cut. Safehold could double in value, and even then it will still trade at a very big discount to what it traded at its peak just a few years ago. And the interesting thing here is that Star Holdings owns a stake in Safe that's worth about 200 million, but its own market cap is only half of that. So essentially, by buying shares of Star Holdings, you get to invest in Safehold indirectly at a much lower valuation, and Safehold itself could enjoy very significant upside now as interest rates are cut over the next years. Moreover, Star Holding has made it clear that their plan is to liquidate in the coming years. In addition to their stake in Safehold, they also own some legacy development assets. Those take time to monetize if you want to maximize the proceeds. With the high interest rates today, it's making it very difficult to develop new sites, and so developers are not too interested in buying that land. But as interest rates now return to lower levels, this will also make it much easier for Star Holdings to monetize this land. And once they've finally gotten rid of these development assets, I expect them to distribute the remaining shares of Safehold to their shareholders to finalize their liquidation, and this could lead to very significant upside. If those development assets are enough to cover their own debt, which I think they are, Then they were able to distribute those shares of SAFE to shareholders. Just that could lead to a doubling of your share price. And then beyond that, Safehold could enjoy a lot of upside on its own as interest rates return to low levels. And so because of all of this, STAR could turn into a multi-bagger in the coming years if my prediction for interest rates plays out. Naturally, when you have prospects for such high returns, that comes with higher risks, and STAR is not an exception to that. If interest rates remain at today's levels or even surge higher, this could turn into a value trap. It has certainly been a value trap in recent years with a steadily declining share price, and this could carry on if we don't get the lower rates that I'm predicting. For this reason, it's just a small position as part of a well-diversified portfolio for us at High Yield Landlord. If you want to access our full portfolio, you can join us for a 2-week free trial. It will be the first link in the description of this video. With this free trial, you will gain immediate access to my full portfolio, all our trade alerts, and all my best research in real time. You won't be charged anything in the first 14 days, so you can join, take a look at the portfolio. If it's not for you, just cancel. You won't be charged a penny. Once more, if you enjoyed this content, please consider clicking the like button. It helps me a lot to keep producing this content for you. Thanks so much, and see you at my next one. Bye-bye.